Hey, everybody. Welcome back to another episode of the Unstoppable podcast. I'm Diana Chen, your host, and I'm here today with my co-host, Matthew Gould, co-founder and CEO of Unstoppable Domains. Hey, Matt, how's it going?
I'm doing just fine, although it's a little cold out.
It is. Yeah. I feel like you've got nothing to complain about in Reno, considering what we're going through in Chicago right now, but the whole country's experiencing it. Thoughts go out, especially to our friends in Texas. That is not fun stuff down there. But anyway, today we're starting a new series. We're going to be talking all about scaling and L2s. What this means in plain English is basically how do we build better on the blockchain. And today we're going to start off by talking about some of the common problems that we're facing with building and scaling on Ethereum and other public blockchains. And I think before we dive into that, though, let's just, for people who aren't familiar with what Ethereum actually is beyond just being a cryptocurrency that you can trade, let's just give people a good, solid background into what Ethereum is and what the public blockchain is before we dive into talking about some of the problems that we're facing. So maybe first question for you, Matt, is what is Ethereum and what is a public blockchain?
Yeah, so let's go even further back because we've had issues with blockchains being scalable since the very beginning. So when Bitcoin first launched, it's a very simple blockchain for tracking transactions from one user to another user anywhere on the planet in a decentralized manner. You don't need a bank in the middle in order to track sending Bitcoin from one person to another person. And since the very beginning of time for blockchains, there's always been this problem with being able to get enough transactions on the decentralized network. And it's a basic computer networking problem where you only have so much bandwidth and you only have so much storage that you can use for everyone to be able to check the records to make sure that they're accurate. And they've been working, everyone in the blockchain space has been working really hard to improve these numbers over the past decade. They have gotten quite considerably better. So the parallel that I like to use for people is when the internet first launched, everyone was on a dial-up modem, and that modem was quite slow. It was like 14 kilobytes per second. And then, it went to 28, and then you can get a 56-bit modem. And now today, we don't talk about kilobytes anymore. We talk in terms of gigabytes for bandwidth. And, I have 100 gigabytes home connection here, which is quite fast and quite pleasant. But that took 25 years to go from our dial-up internet to our very fast broadband. So blockchain systems like Bitcoin or any decentralized system has problems as well with speed, which affects how many transactions can go through at a time or how many people can be using the network at the same time. Analogous to the same problems we had with the internet when it was very early. One thing that's significantly better, though, is that the problems with blockchain are not about having to lay fiber down or anything like that. We don't need to build new communication networks. Someone doesn't have to come out and dig a ditch and run a line to your yard. You already have the internet to your house. And really, it's just about coordinating information between all of these different participants on this network. So I'll pause for a second there, see if any of that made sense.
Yeah, I think it always helps to draw a parallel to how internet was developed and grew back in the day, because that's what everybody's familiar with today. So I think that's a good overview. And so when we're talking about Ethereum, for example, let's just clear this up for everybody listening who's maybe not familiar and thinks that Bitcoin and Ethereum, they're all the same thing. Talk about why Ethereum is different and why everybody's talking about gas prices on Ethereum and things like that you wouldn't deal with on with Bitcoin necessarily.
Interesting. Yes. So I'm gonna go to Bitcoin one more time, and then I promise I'll get to smart contract blockchains like Ethereum that you want to get to. So just back in 2009, when Bitcoin was launching, everyone at the very beginning was like, "Oh, there's only so much room to fit transactions on the Bitcoin blockchain, and it's eventually going to be a problem." And eventually what happened is the Bitcoin protocol got full, and they actually did have problems with processing more transactions. And there were a lot of people working on ways to increase the throughput of Bitcoin at that time. And then a couple of projects launched that actually just made copies of the Bitcoin code, and then people could do transactions over there. So Litecoin is another famous cryptocurrency. It's the silver to Bitcoin's gold. Was launched, and then you could see traders. And because the Bitcoin network was congested, just like dial-up modems, it was too slow to download a website in the 90s. People would switch over and use the Litecoin network because it was faster to transfer cryptocurrencies. But then, it wasn't really a solution to the problem, because then the Litecoin network and the Bitcoin network were two different networks, so you couldn't communicate between those as well. And the new blockchain could also just fill up. So they actually tried several different ways have been suggested for scaling. They all have a bunch of different trade-offs for these blockchains. And there's still an open question on the absolute best way to scale, specifically for Bitcoin itself. And they may even argue it's not really that important for them to scale on the Bitcoin main layer, which is known as layer 1, because there are protocols on the Bitcoin secondary layer for scaling. So that's a little bit about Bitcoin. And then I'm going to pause for a second. I'm going to go chat about Ethereum since you asked me about it. So Ethereum is a smart contract blockchain, and it introduced the concept of gas, which was a new thing that was made because Ethereum runs programs. And you have a problem with having a program that runs on the blockchain, because what happens if that program has a loop? And in computer science, if you have a program that has a loop, it's like, hey, keep doing this thing, 1,000 times, 10,000 times, 100,000 times. You can actually have a program where someone says, do this thing infinite number of times. And it's the halting problem. And there would be no way to stop that computer program from running on a smart contract blockchain. So this is actually not a problem that Bitcoin has. It's just a problem that smart contract blockchains have. So smart contract blockchains have this problem where they say, hey, we want to make a more generalized blockchain. And we talked about this on a previous episode, but we want to make a more generalized blockchain so that people can have much more expressiveness in all the things they want to do. And they introduced a new problem for themselves when they did that, which was what happens if we have a program that runs a loop. So they introduced this concept of gas, which basically means you can keep running your computer program as long as you have gas. And then when you're out of your gas, then the computer program will stop running no matter what. Just like your car, if you run out of gas, you're done. And so that was a way for them to say, we don't care what computer program you write, we'll run all the operations, but as soon as you run out of gas, you're done. And that prevented this problem with someone putting an infinite loop into the smart contract blockchain. So we have like two different types of blockchains here. We have the Bitcoin blockchain, which has a UTXO output, is like the way that people put it. And they don't really have a rich smart contract language, but they're very good at their job of tracking Bitcoins in this instance, or just, the currency native to that blockchain. And then we have these smart contract blockchains, which allow you to do a lot more things. And they introduced a gas fee as part of their design. So when you send Bitcoin from one person to another, you have a transaction fee, and you can raise or lower that transaction fee. But the amount of computation for that network is the same, because you are just putting that transaction through. Whereas on Ethereum, when you submit a transaction, you could actually be making a call to a program that could run something that's quite complex. And that's why they have this gas thing. So there's a little bit difference on how the two types of blockchains, smart contract blockchains and Bitcoin-like blockchains, manage the usage of their blockchain space.
Okay, so if I were to reduce this to super simple, basic English terms, would it be fair to say that with smart contract blockchains, you can build more complex apps and programs? And then would it be fair to say that the whole deal with gas prices is basically to prevent traffic jams from happening when too many people are trying to run infinite loops and there's just not enough capacity?
I think that's an okay way of putting it. Yeah, I would say smart contract blockchains introduced this concept of gas because they wanted to be able to run computer programs and they needed to have some way to prevent people from taking advantage of the system.
Got it. Okay. So a couple of other terms that you hit on when you were talking about Bitcoin, the Bitcoin blockchain was L1 and L2. So now let's move into more of the problems that we're facing with building and scaling on the blockchain. Talk more about what do you mean by L1, layer one, and then what do you mean by layer two?
Okay, yeah, this is good. And I'm going to start with Bitcoin because it is the older one and it's also easier to understand. So you have the Bitcoin blockchain, and you can send Bitcoin around to each other on that blockchain. And the problem is, what happens if too many people start using Bitcoin? And then you say to yourself, wow, there's not enough room for everyone to fit their transactions in. So the wait times get really long on Bitcoin to process the transactions. And then the fee for sending a transaction, which is what you can pay to get your transaction prioritized on the Bitcoin network, is going to go up a lot if you want your transaction to be sent very quickly, as opposed to one that if you're okay with waiting for 3 or 4 days. And it's just a problem in economics. There's only so much supply for transactions to fit onto the network at any given time. And if the demand is higher than that supply, then it's going to cause a lot of backlog because there's no way to make it larger. It's a hard limit on how much transactions can go through on Bitcoin in every 10 minutes. So people are like, what can we do about solving this problem? And the easiest one is to just raise how much information you can store on the Bitcoin blockchain. And this was called the block size limit debate, which happened way back when in 2013. The problem is, if you raise the block size limit, if even more people come on, so you raise the limit. Now you can say, okay, twice as many people can put out transactions, every hour or whatever. And what happens is when it fills up again, you're just going to have to keep raising the limit again. And then every time you raise the number of transactions that you allow to go through on the network, at a given time, the amount of computing power that you need for storage, the amount of storage that you need goes up. And so you have this problem of decentralization. And Bitcoin was very concerned with, hey, we really want to have a very strongly decentralized network. And we want everyone to be able to run the Bitcoin software in their house. And that means that we need to make sure that the software that you're running doesn't get too big. And it got, it's terabytes and on some blockchains. And it's looking like it's going to get even larger. So there's a lot of discussion around the right way to scale blockchains, but pretty much everyone came to the conclusion that just continuing to increase the size of the blocks over time is not a great solution, because it's just going to become prohibitively expensive for people to run these nodes themselves. So that was one, the very easy way that we can solve the problem of congestion and making blockchains faster is just make the amount of storage that we can put on a blockchain larger. So that was the first attempt. And then people said, well, maybe we can do a little bit better than that. And they're like, how about if we can aggregate some transactions together? And the first way that people tried to do that was with a technology called state channels. And just to make it super simple, it's kind of like if I have a transaction for you, like you and I want to do a transaction, but let's say that we do 3 or 4 or 5 or 10 or 100 transactions per month. Instead of publishing all 100 of those transactions, we could just wait to the end of the month and then publish one transaction, right? And so a lot of people got excited about using this, because that means that if you could just track around a bunch of relationships between everybody using software and know who was going to be transacting with someone else frequently, you could reduce the number of transactions that everyone does. Everyone could maybe just publish one transaction in a month, and that would be enough to handle all of their different transactions. So that was another very early technology. And those are two ways that people were approaching the problem. And then since then, we've opened up 5, 6, 7 other, a half a dozen other ways that we can potentially scale blockchains. And they're all extremely actively debated. Everyone has a very strong opinion about these. So I'm going to try to be careful because I don't want to offend anybody out there. I actually think all of these scaling solutions are useful in one way or another. But those are some of the earliest ones that we saw.
Okay, and so those solutions that you just said, are those L1 solutions or L2 solutions?
Yeah, so the first one that I talked about, where you just make the block size bigger, that's an layer one solution, which is known as an L1 solution. And they use that notation because it makes it easier when you're talking about designing a blockchain, because to say layer one versus layer two. So that first one, where you just make the block size bigger, okay, that's great. That's on the original Bitcoin blockchain. That's on L1 type solution. That means the blockchain is faster for everybody who's interacting with it. And then the another example of an L1 solution would be to make the block times happen faster. So everyone knows the Bitcoin blockchain, every 10 minutes is when it publishes a block. So what if we just publish a block every 5 minutes, right? And then that could potentially increase the throughput of the Bitcoin blockchain by 2, right? Because you have twice as many going through. And that's another solution that a lot of people suggested for the for a layer one solution. And what's funny is in the early days of Bitcoin, there was a lot of debate around both of these topics. Like, hey, can we make the Bitcoin blockchain just store more information? And that would be a layer one solution for increasing capacity. And then another one was like, hey, can we just make the Bitcoin blockchain do block times faster? And these two simple questions led to like a whole bunch of innovation on what could we potentially do to make it better and to save a lot of discussion. The reason why a lot of people in the Bitcoin space have said, no, we can't just continue to increase the number of transactions we allow through, is because the size of the computer you would need to run the Bitcoin network would just get too big for most users. And so it wouldn't be as decentralized. And then for the other one on block time is like, hey, why can't we just do a Bitcoin block every 2 seconds, right? Like that would be great. And the problem there is you need to have confirmation period that's long enough for everyone to feel confident about the validity of the blocks. So you actually saw a lot of blockchains that had like, oh, we have 10-second block times or whatever, but then they would just say, oh, we want to, now you have to wait, instead of waiting 1 block or 2 blocks to feel good about it, you need to wait 100 blocks because for security reasons, you want to have more time to know that it's good. So both of these solutions for L1, for just scaling on the blockchain at the base layer, were kind of seen to be limiting, right? And there's all sorts of arguments. Like, yes, you can definitely increase the blockchain size a little bit for Bitcoin. There's another version of Bitcoin, like Bitcoin Cash, and the block size is 8 times bigger. So it's definitely theoretically possible to make it work that way. And then you can also speed up the block times because there's lots of different chains that have faster blockchain times than Bitcoin, like Litecoin, for instance. But the problem is it doesn't seem like it's going to scale enough for global scale, right? All of these little solutions are like, oh, we can have 2x as many users. So, but Bitcoin users is really tiny, especially back then. And it was like, oh, you can handle 1 million people. And that's not really the same as handling 3 billion. You need like 3,000, 10,000, 100,000 times faster, especially if everyone wants to do everyday transactions. So those are the early L1 solutions. And then I'll pause here and make sure that made sense. And then we can talk a little bit about the different ideas on L2.
Yeah, well, why don't we? I guess like the only thing that would be helpful for me is to give some real life examples of how users can face these limitations today. So like I'll just throw one out first. Is the other day I tried to buy a CryptoKitty. I know I'm like 4 years late to the game, but finally tried to get into CryptoKitties. Tried to buy a CryptoKitty for like it was like $8, the equivalent of $8. And then I went to go purchase it and it said the gas price was like $4,000. So it basically was asking me to pay like $4,000 to buy a CryptoKitty that was supposed to cost me $8 that I was just playing around for fun. So that, obviously it didn't go through with that. But can you just explain the back end problems that were causing this to happen to me?
Yes. So what you're talking about specifically is now we're moving forward. So I was just talking about blockchain back in 2011, right? And so now you're moving forward to 2021. You're like, Matt, why is it going to cost me $1,000 to get my CryptoKitty? And the truth is we have a lot more users now than with a lot more applications than we did back in 2012 and 2013. And they have just push the prices of interacting on chain because they want people pay more to get their information stored on chain now. because there's more people that want it. So they're competing with each other. And they have pushed these prices to just absolutely obscene levels in the past 6 months, I would say, especially since DeFi, because everyone's using these DeFi trading apps. And the technologists working on scaling blockchains simply have not been able to keep up. They haven't been able to increase the throughput of the blockchain as fast as the user growth for wanting to use these blockchains has gone up. And Ethereum is actually an interesting case because remember, I was just talking about layer one solutions where you can increase how much information you can store. And so Ethereum has actually increased its block size at least 2 times, if not 3 in the past couple of years, where they just kept adding like another 30% or 20% to the block size. And then every time it just got filled up. And again, it's that whole thing where, oh, you can increase the amount of transactions that can go through, but what if more users come on? You're eventually going to hit that limit again. And so I would actually say the reason why you're suffering these gas prices today, and everyone who's listening, is because the technology is working really hard to try to catch up with demand. And so and now there's a lot of incentive to solve this problem, which is great because now entrepreneurs are coming in and working on scaling solutions to try to bring these transactions down. And I would say that the majority of the effort now for bringing gas costs down are using different ways of compressing the amount of information that you have to store on the main blockchain, on the L1. But still allowing people to verify the contents of those transactions on their own. So the idea is you want the transactions on the main chain to be as small as possible, so they don't contain any extraneous information, while at the same time increasing the total amount of information that can be stored in those tiny transactions, so that people can verify it on their own, like building systems for them to verify it. And those are all the layer 2 solutions. And so the distinction here between layer one is something that's happening on the blockchain protocol level. And then layer 2 is some system that you build on top of the blockchain for tracking ownership data about blockchain assets, and then pushing that information, like a small piece of that information, onto the blockchain itself that people can use to verify whether or not that's true. And so that's pretty complex, but let's talk about your CryptoKitty for a second. You can actually, I believe there are some layer 2s out there already that support CryptoKitties. And what you can do is deposit your CryptoKitty onto a layer 2, and then any action you do in that layer 2, you can trade around that CryptoKitty 100 times and breed it or whatever else. And then at the later date, when you want to move it back to the layer 1, you just push one transaction. Instead of pushing all the 100 transactions you did over the 3-month period, there's just one that comes out. Now that works even better for something like a stablecoin. So there are stablecoins looking at moving to L2s. Also, DEXs for trading are looking at to move to L2s, because you can imagine everyone takes their money and then they all deposit it into this exchange on chain, on the blockchain, and then they can trade with each other. And there's, everyone's going to be switching around their balances. And then when you want to leave, you can just publish your balance at the end, and then you leave the rest of it on chain. So if you lost money trading, then when you leave, you're going to have less than when you got on. And if you made money trading, when you leave, you're going to take more with you. But no one has to know any of those transfers in between. So the amount of information that you have to save is a lot less. And if you think about it, this sounds a lot like state channels, which I mentioned at the beginning of this, which was the very first layer 2 solution that people proposed at the beginning, which is like, hey, Diana, if you and I are going to transact 100 times this month, how about instead of doing 100 Bitcoin transactions, we just do one transaction at the end of every month? Okay. And so a lot of these L2 solutions, that's exactly what they're doing. But they're much more complex now, because you can take hundreds of transactions between, like, let's say, thousands of people on Uniswap, for instance, and we can all do hundreds of transactions with each other. And then we aggregate all that data back and we just push it on chain. And the goal, the holy grail for all of these scaling solutions, is to find something that is a constant size. And so this is a computer science thing that can prove an infinite number of of updates. And you're like, what the hell does that mean? And that would mean like if we had a Bitcoin blockchain and we just say, hey, the block size is always going to be exactly this, and we're only going to publish it every 10 minutes. But if we can figure out a way to compress the data so that you can read that block and you can prove 1,000 different changes or 10,000 different changes or 100,000 or 1,000,000 or 10 million, but it's all going to be the same size because this is just the summary information. That's the holy grail. And we're getting close. And there's all sorts of math around exactly how that works. But at a high level, they're trying to figure out what everyone's working on is how do we just continue to compress and compress and compress the amount of data down into the absolute smallest possible size so that, and then hopefully we can compress the data down so small, in fact, that if you need to add an extra transaction, it actually doesn't change this size at all. And in our example, if we did 100 transactions back and forth in a month, if we decided to do one more and we did 101, we still only need to publish one transaction to the main blockchain, even though we did an extra transaction in that interim step. So what I'm just trying to demonstrate it is possible, because you can imagine us doing 200 transactions. And again, we just have to publish the net result of the month that we did there. And so that's the goal that the people are all trying to work towards. And that's a much better solution than the first solutions that were proposed for blockchains, which was, hey, let's just make the blockchain bigger and let's just make the confirmation time faster. And those two solutions have proven again and again to be temporary because the demand for this stuff is just really high right now. So I'm sorry that your CryptoKitty cost $1,000, and I'm hoping that you didn't buy it.
I definitely did not, but I'm going to go search for an L2 solution now so I can buy it for a reasonable price. So with the solutions that you're talking about with L2, are there any limitations to that, or do you foresee that being the end-all solution that's going to allow us to scale globally and there's no limit to how much we can scale with this solution?
So I was actually doing the math on this the past couple of weeks and just trying to get a feel for kind of where we're at right now. So just to put some numbers on it, there's probably on a busy day on Ethereum, there's probably several 100,000 active cryptocurrency users. And on those busy days on Ethereum, the prices get too high, like your CryptoKitty costs $1,000. So I'd actually say that that's not functional at that point. So, and that's only with 500,000 users. And if you're looking at the solutions that are out there for scaling, and just to be clear, there are lots of different scaling solutions that that will function on the layer 1 and then also layer 2. There's also side chains, and there's all sorts of different ways that people can use to scale, and we'll talk about all of these. But even if you combine all of those together right now, none of them are looking like enough to get us to global scale, because the best ones out there, like we just talked about, where we could aggregate like 100 transactions and turn it into one or something. The problem is it becomes very difficult to aggregate groups of people's transactions in a way that makes sense, and you're gonna have some differences between different types of transactions, and people are going to be using them. So there's going to be more than one solution for scaling. And then all of those solutions are going to need to publish a little bit of information to the blockchain. So I would say it's a little bit undetermined at this point exactly how it's all going to work out over the next, in the very long run. Now I can speak much more confidently about the medium term. And in the medium term, I think it's very likely we'll see 100 to 1,000x improvements. So if we take the numbers, I'm saying on a hot day right now, on like a very busy day on Ethereum, you could expect 500,000 users. I think it's possible that in this next wave of innovation that's happening right now, it's actively happening this year and next year, we'll be able to increase the throughput for these open blockchain systems by 2 orders of magnitude. So that means instead of like maxing out at about 500,000 users, like active users of the blockchain, I think we're going to max out around 50 million with current technology. And I've got a spreadsheet where I'm, actually like running these numbers, and somewhere right around 30 million daily active users of any one of these L1 blockchains, any of them, the smart contract ones at least, is kind of where the technology limit is at this point in time. Now, I'm very optimistic past that. Like, it's very, like, definitely we can get there. So we can get 100x better than we are today. And if you think about it, 30 million is halfway there in a log scale to global, right? Because we get another 100x improvement from 30 million and we get to 3 billion. And that's how many Facebook users there are. So that's like how many daily active internet users there are. So next 1 to 3 years, the technology will be here so that we can 100x the number of people participating in these things at reasonable prices. So your CryptoKitty will cost 5 cents again, right? And then so that's the next 2 years, and I'm feeling really good about that. And then next 1 to 3, right? And then past that, the types of improvements that we're going to need to see are going to be some algorithm improvements on the proof systems for the L1, like the core blockchains like Bitcoin and Ethereum, specifically Ethereum. And there'll be some optimizations around some of these L2s. And I think there's going to be some innovation in being able to process the proofs a little bit, process things faster. So it'll be a combination of tools that it's going to take to make it happen. And we can continue to discuss that over the next couple of episodes. So I don't want to go too deep here off the deep end, but I think that was a pretty good high level overview.
Yeah, I think that was great. We don't want to give away all the juice. We want to save it for future episodes. There's a lot more to talk about with the solutions that are being built out. But overall, this is really exciting stuff and really positive too to hear that solutions are being built and that they're being built, right now, and that we're going to see visible changes in the near future. So this has been great, Matt. Thanks for this overview. Thanks everybody for tuning in, and we will be back again soon with another episode of the Unstoppable podcast.